प्रेजेंटेड बाय eBix कैश। हर खुशी के लिए काफी है।
Hello and welcome. You're with us here on Business Today. I'm Abha Vakaya. Here are the headlines tonight. Bears tighten their grip on the Lal Street on weak global cues. The Nifty ends below 17,900. 42 out of the 50 Nifty stocks end in the red. Sensex stumbles from Mount 60,000. Zomato zooms in trade despite weak Q2 numbers. Loss widens to 435 crore rupees. Brokerages maintain a buy rating on the stock. India's biggest IPO, Paytm, may have found some takers, but unlike some others, there were no over-the-top demand for its pricey shares. Meanwhile, grey market premium of 30 rupees a share also reflects the not-so-encouraging response. Dollar soars to 16-month high after US inflation surges to a 3-decade high. The rupee depreciates by about 18 paise to end at above 74 against the dollar. And all your stock queries answered later on the show with Udayan Mukherjee. Markets extended losses in trade on Thursday ahead of IIP and inflation numbers due tomorrow. The Nifty saw support at the 17,800 mark, finally settling down 144 points at 17,873, while the Sensex slipped below the 60,000 mark, ending the day down 433 points at 59,920. Among the sectoral indices, Realty, PSU Bank, Pharma, Media, Auto, these indices lost between 2 to 3%. The selling was fairly widespread, with broader markets also witnessing heightened volatility. Top laggards today on the Nifty: SBI down close to 3%, ONGC, SBI Life, Bajaj Finserv and Tech Mahindra. OMCs were also trending lower in trade, with IOC down over 4%. BPCL and HPCL following suit. Energy and environment solutions company Thermax reported a threefold jump in profit in Q2 FY22, indicating green shoots for demand recovery in the economy. Thermax numbers show a bigger picture of economic revival. Thermax provides services and products related to heating, cooling, water and waste management, specialty chemicals and many more. Q2 profit after tax saw a jump of 183% year-on-year at 88 crore rupees. Last year, during the same quarter, the company closed its German subsidiary. Thus, this profit jump was witnessed as a result of low base in Q2 FY21. Also, the company posted a 29% year-on-year rise in consolidated operating revenue to 1,469 crore rupees during the September quarter. Reacting to the stellar numbers, the stock was up by nearly 11% during trading hours today. India's largest public issue, the 18,300 crore rupee offering by Paytm, has closed, but a closer look at the subscription data and the grey market premium shows that investors remain deterred by the high valuations and business prospects of the Vijay Shekhar Sharma founded company. Here's the story of why Paytm's issue did not generate the same hype as some other issues like Zomato, Nykaa and Policy Bazaar.
It started live offering prepaid recharges for mobiles, with the name Pay Through Mobile reflecting that. But its public issue that closed on Monday showed that smart money may not have dipped into their ATMs to buy the shares of Paytm. And now the grey market premium of Rs 30 a share also reflects the not-so-encouraging response from bidders for an issue priced 48 times FY21 revenue. Paytm's IPO barely scraped through thanks to the last day push by FIIs. Domestic mutual funds cumulatively bid for only 348,828 shares of the 48.4 million on offer. This was one of the lowest participation from mutual funds in an IPO in recent memory. Domestic institutional investors who have been active participants in the IPO frenzy virtually ignored the issue. So why was Paytm unable to ride the IPO wave which other startups have benefited from? Concerns about the high valuation and complex business model deterred investors. The issue of the loss-making company was valued at close to 50 times its previous year's revenue. The signs of disdain for the IPO from domestic mutual funds were visible as only 4 local asset management companies participated in the anchor book of the company before the public offering. Paytm is a household name, but there are many unanswered questions over the company's ability to challenge market leaders in new businesses. It started off as a payments application, but quickly saw much of its market share dwindle as competition jumped in. The company then shifted focus to e-commerce, but its fortune in that space also failed to take off due to market dominance of Amazon and Walmart-backed Flipkart. Post that, the company has entered other spaces like insurance broking, payment bank, and competing with likes of Zerodha and Policy Bazaar. These are the factors responsible for India's biggest IPO not enjoying over-the-top demand that investors afforded to the likes of Nykaa, Zomato, and Policy Bazaar, as analysts believe that the company is still struggling to sell its business model. Bureau Report, Business Today Television.
In an exclusive conversation now with our global business editor, Udayan Mukherjee, Bajaj Finserv CMD Sanjeev Bajaj talks about the features of their upcoming digital platform. He also sheds light on the timeline of the app release. Watch this short excerpt to know more.
Could you give me a sneak peek into what a Bajaj Finserv consumer will actually be able to experience when he comes on to your app when the whole thing is unveiled in February, in simple terms?
We started this exercise about a year and a half back, and we first started it when the first lockdown came in. We had a lot of ample time and there was no business because everything was shut. So we first went through basic housekeeping, cleaned up a lot of processes that we had built over time and not had the chance to question, and this way created a more leaner operating environment. And while we were doing that, we realized that there were many aspects in the digital transformation space that we had embarked. So we have a digital wallet with MobiKwik. We've had that for the last couple of years. We have nearly 20 million customers on that. We have a UPI handle, Bajaj Finserv Pay, which we use for UPI transactions. We already have various properties that app properties that interact with customers, which have been built over a period of time. We saw the opportunity to bring these together, keeping in mind what's the latest technology available, what's the expectations of customers, what our peers, and our peers not just in financial services, but across sectors, are doing in the way they are building intuitive tools, interacting with customers. And we decided that there was an opportunity to build a set of platforms, updated set of platforms with class-leading customer interaction and experience. And that's what we are in the process of doing. So we have a lending platform, we have an e-commerce platform for all our consumer product financing, we have an insurance platform, we have an investment platform, and we have the payment platform. The payment platform is something that we have just started rolling out. And this has not only our own digital wallet now, because we've got the PPI license from RBI last year. It also has, as I said, UPI as a method of payment. It's got our digital EMI card. Nobody else has that in the country. We have over 15, 18 million EMI card customers. And it has our digital credit card, which we have one launched with RBL Bank. We have a second one that we will launch with another bank next year. So the payment platform is now in place. It is getting rolled out. And between now and February, March is when we will roll out each of these platforms. The benefit of creating them in a modular manner is that these platforms can then be worked on independently because customer behavior sometimes and expectations can be different. Plus, these are different products. We are dealing with different partners and intermediaries as well. But the technology at the back end has been created by our team. And as a result, that is seamless, So you can run each of these platforms individually, you can run them together. So they work that way as well. And we think platform as a business itself could be an exciting idea a few years down the line. So it would allow us even to do that.
Now, since you mentioned the payments platform, and I can see how the architecture will work, the big question is, how do you basically place these platforms or these proprietary platforms against digital players who are focused on one of these pieces at the time? Like in wallets, it would be Paytm. In your proprietary broking platform, you would have to go up with the likes of Zerodha. How do you see Bajaj Finance competing with these focused fintech players who are also trying to do the same thing that you are doing, but they're more focused because they're tackling only one part of it?
So that's both an interesting, a reasonably obvious question as well. So when you look at each of these players, what they've done very correctly, as you've said, is that they've taken up one piece of the puzzle and they've tried to get really good at it. And the way that we expect to compete is through our modular structure by having our equivalent piece work as well, if not better.
Public Sector Shipping Corporation of India has incorporated a wholly owned subsidiary, Shipping Corporation of India Land and Assets Limited. This is as per the recommendation of the Ministry of Ports, Shipping and Waterways and Niti Aayog for hiving off non-core assets of the company for demerger ahead of SCI's proposed disinvestment. The US Justice Department has filed a lawsuit against Uber for charging wait time fees to passengers who, because of disability, need more time to enter a car. The State Department said Uber's policy had harmed passengers with disabilities. The lawsuit alleges that Uber has violated US laws which prohibit discrimination by private transportation companies. In its bid to strengthen localization in overseas markets, IT services firm HCL Tech has announced an apprenticeship program in the US to train and hire high school graduates. Upon successfully completing the program, apprentices will be offered full-time employment at HCL and have the opportunity to concurrently pursue a debt-free college education. India's largest auto company, Maruti Suzuki, has said that it's revised downward its FY 2021 full-year forecast for sales volume and net sales figures. However, it said despite expected decrease in production, its forecast for operating profit is kept unchanged, taking into account the depreciation of yen and cost reduction efforts. You're watching Ask Udayan, the show where we answer your questions on stocks. I'm Abha Bakaya, with me, our global business editor, Udayan Mukherjee. The Indian stock market is trading close to record highs. Investors sometimes unsure whether they should stay invested or book some profit. So what are some of the best investment strategies you could apply in a market that is booming at a time like this? Udayan, of course, with us to give you some of those answers and to also look at specific stock queries every Wednesday. Do continue to send in your questions at the number on your screen, and we will, of course, take some of those. Let's start off with the ones that we've picked today. Our first question is from G. Chadha in Gurugram. Let's listen into his query.
Udayan, what will be the market forecast for investment in Happiest Minds for 1 year investment period?
Well, as you know, Happiest Minds has been an absolute cracker. I mean, I think it's a three-bagger over the last 1 year, and I can understand the interest in that counter because people have made so much money over the last 1 year in that name. I think it's gone up a lot already, and therefore one needs to be a little careful about the price. As a company, it's a very good company. I mean, that's why the stock is doing so well. And it's got an excellent promoter. The management is very good. The unique thing about Happiest Minds is unlike a vanilla IT services player, like say the likes of Infosys and TCS, this one is focused more on the digital segment of the entire IT piece. And since there is an explosion which is going on in the digital universe, obviously people are willing to pay a much higher price for a company like Happiest Minds, which is targeted at that digital segment. Now, the problem with Happiest Minds, and the only one, is that while it's a very fast growing company, and in the next 2 or 3 years it will probably continue to compound at 25% plus, which is a very healthy growth rate. The issue is of valuations, because the stock is already trading at about I think a P multiple of something like 80 times. I mean, that's very, very lofty for an IT company. But so you need to be a little careful about the entry point. The stock has already corrected. Of course, it was almost at 1600, has come back to about 1300. So if you get it in corrections and as close to the 1000 rupee mark as possible, I think it's probably a good one for the long term. I would also request you to tweak your holding period to more than 1 year. I think for a stock like Happiest Minds, it's best to hold for maybe 3-4 years and let this whole digital drive play out. It may be more rewarding for the longer term, but just be mindful of the price and the valuation.
Here's another interesting question from Praveen Prakash in Bengaluru. Let's listen in.
Hi, I have purchased Amaraja batteries at an average price of 882. I'm looking for a long-term investment of a span of 3 to 5 years. Should I hold or exit?
Well, Amara is not a bad company. I mean, if you are looking at the auto batteries and auto component space, I think it's probably the best bet. I would say that if you look at the comparative performance between the two big companies there in the listed universe, which is Amara Raja and Exide, Amara Raja is probably a better performer compared to Exide over the last 3-4 years. It's steadily gaining market share. It operates on better margins. The return profile, return on equity, is also slightly higher than Exide. So I would say between the two, Amara Raja is probably the better stock to own. But you bought at 880 and the stock is already at, I don't know, close to 700 level. So you're sitting on losses out there. And the market is not seeming very confident and gung-ho about prospects for Amara Raja. And part of the reason, of course, is to do with what's going on with expectations on electric vehicles. Because the traditional auto and the traditional auto battery segment is something which investors are a bit skeptical about. So Amara Raja will have to prove its mettle on the lithium ion batteries front to demonstrate that it's going to be a credible player in the electric vehicles arena as well. So I think that's one challenge. The other is that copper prices have been going up, lead prices have been going up, and because of raw material price inflation, their margins are also getting squeezed a bit. So on both these counts, the EVs factor and the operating margin squeeze, I think it's very difficult to see how Amara Raja will be a great performer over the medium term. So while it's a good company, I would say maybe it's a better idea to look at other companies as well, even outside the auto space, for the kind of time horizon that you spoke about.
Okay. Ajinder Kaur has also sent in her query, and we've got a lot of queries coming in from the broader markets today. Listen into this one.
Hi Udayan, my question is, what is your view on APL Apollo tubes? Should I buy at current levels? Thank you.
Well, APL Apollo is a very good company, and if indeed there is going to be a rebound in the investment cycle and the capex cycle, as most market participants seem to believe, I think APL Apollo is positioned quite well to ride that wave. It's been a very good performer as well over a period of time, and in fact in the last 2 or 3 years it's been one of the best mid-cap stocks. Again, the issue is about valuations. Your question is about an entry into that stock. It's already trading at about close to 28-29 P multiple on FY23 earnings, so it's not exactly cheap. Compounded with the fact that steel prices have been going up, so they might face some kind of challenge on their margins in the foreseeable future, because steel prices may not cool down immediately. Of course, if they manage to sell more value-added products, which is the hope, then they could pass down some of the steel price hike and preserve and protect their margins. So it may turn out okay for APL Apollo, but I think the key thing to understand is that it's a good company in a good space. It's an absolute leader in the pipe segment, and therefore, if you don't mind going without great returns for small periods of time, 2-3 quarters on the trot, I think it's probably an interesting name to have in one's portfolio for a longer time. I'm not going to be a judge of what is the perfect entry point because of where valuations are now. But having said that, the stock is trading at 15-17% lower than its peak that it hit a few months ago. So it has corrected somewhat from the top, and therefore you would not be buying it at all-time highs. So this is not a recommendation for buying that stock at all. But I think it's probably a very, very good portfolio stock for a mid-cap investor.
Samarth Parekh also has sent in his query, and this one's from Kolkata, particularly on the tech space, given all the action that's been brewing there. Listen in.
Hi, then. welcoming the Amitabh Bachchan of the last seat back. It's very nice to see you again. I just wanted to ask you whether Mindtree can become the next Infosys or TCS. It's been outperforming the IT pack, but what is the future?
Well, as you said correctly, that Mindtree has already been outperforming the frontline IT stocks quite handsomely. In fact, I think I wouldn't be mistaken in pointing out that it's probably the best performing stock of any size in the IT space over the last year or two. I mean, it's been an absolutely stellar performer. And part of it, I mean, of course, it's well deserved because it's growing at a much faster clip than most of the IT names that you mentioned. I think Mindtree has been growing at 35% on the revenue front in dollar terms, and that is absolutely astronomical. But because of this reason, it also trades at near all-time highs, and it's trading at a premium to even TCS, which is the big daddy of the IT space. I think TCS trades at about 32 times. Mindtree is probably trading at 35 PE multiple. So, a 10% premium to probably the bluest chip in the IT space takes some doing. I think you cannot fault Mindtree on the kind of execution that it's doing. Even the quarter gone by, I think the revenues went up 13% quarter on quarter. I mean, that's really a hard act to follow. So it's a good company, good management, excellent growth track record, and nothing to suggest that their growth is about to slow down immediately. If you own the stock, good luck to you. By all means, it makes sense to keep it in the portfolio. And maybe use corrections. Periodically, you do get corrections in the market, and that's when you should try to look into adding to your portfolio on stocks like Mindtree, which, as you said, is the best in class on performance in the IT space over the last 4 or 8 quarters.
All right, that's all we have time for on this edition of Ask Udayan. Do continue to send in your queries. As promised, we'll take a few of them every week. Udayan, thanks so much for your time. That's all we have on the show today.